Ever wonder how your money disappears while bankers get richer? You trust them with your life savings. But behind marble columns and polished smiles, they're playing a different game altogether. The financial world operates on a simple illusion that these institutions protect your wealth. Yet, somehow, Wells Fargo created millions of fake accounts and HSBC laundered cartel money without anyone noticing. In this video, we'll uncover the 33 most outrageous banking scandals that drained billions from ordinary people while executives walked away with bonuses and golden parachutes. Because nothing says too big to fail, quite like being too corrupt to care. One Wells Fargo account fraud scandal isn't just a corporate mishap, it's the Sistine Chapel of financial duplicity. Between 2009 and 2016, employees created over 3.5 million unauthorized customer accounts, while management looked the other way. Why? To hit impossible sales targets that would trigger bonuses, of course. The average American just wanted a checking account, not 17 products they never asked for. Wells Fargo's defense amounted to blaming a few bad apples while ignoring the pressure cooker culture they'd created. The scandal eventually cost the bank $3 billion in fines and a congressional tongue-lashing that became required viewing in business ethics classes. The aftermath forced every major bank in America to re-examine their incentive structures and sales practices, proving that sometimes it takes millions of victims to change a single paragraph in a corporate handbook. 2. In 2004, HSBC decided money laundering was apparently just another banking service. For 6 years, the financial giant processed billions in suspicious transactions for Mexican drug cartels with the compliance oversight of a sleepy mall security guard. The cartels would literally design special boxes that fit perfectly through HSBC's teller windows to deposit their blood money. When regulators finally caught on, HSBC paid $1.9 billion in fines, which sounds impressive until you realize it represented about 5 weeks of profit. No executives went to jail, naturally. The settlement created the blueprint for what critics call too big to jail, where massive financial institutions essentially purchase immunity from criminal prosecution. The case transformed banking regulations worldwide, establishing that banks must actually know their customers, revolutionary concept I know, and can't just accept duffel bags of cash without asking questions. 3. The London Whale sounds like a Batman villain, but it was actually the nickname for Bruno Ixiel, a J.P. Morgan Chase trader who lost $6 billion in 2012 through catastrophically bad bets on credit derivatives. This wasn't a rogue trader situation. This was J.P. Morgan's chief investment office, supposedly managing the bank's risk, creating enough of it to sink a small nation's economy. CEO Jamie Dimon initially dismissed the mounting losses as a tempest in a teapot before having to eat those words with a side of humble pie at congressional hearings. The whale debacle exposed the fiction that big banks had learned risk management lessons from 2008. It directly influenced the Volcker Rule implementation, limiting banks' abilities to gamble with federally insured deposits. Sometimes the most effective financial regulations are written in the aftermath of spectacular failures that cost enough zeros to make lawmakers temporarily overcome their campaign donation loyalties. 4. You might think LIBOR manipulation sounds boring. You'd be catastrophically wrong. Between 2005 and 2009, Barclays traders casually rigged the interest rate that underpins $350 trillion in financial contracts worldwide. Traders would literally message each other things like, "Can you set LIBOR a bit higher today? I've got some positions." This wasn't just financial fraud, it was financial fraud with the subtlety of a cartoon villain. Barclays paid $450 million in fines, becoming the first bank penalized in what would become a global scandal. The case exposed how easily a handful of bankers could manipulate a rate affecting everything from mortgages to student loans to municipal bonds. The revelation that the world's most important number was essentially being set by a financial fraternity resulted in LIBOR's complete overhaul and eventual replacement. The entire global financial system had been built on a foundation of trust that turned out to be about as solid as a sandcastle at high tide. 5. UBS didn't just help wealthy Americans avoid taxes, they turned tax evasion into a luxury service. From 2000 to 2007, the Swiss bank helped approximately 52,000 clients hide assets in secret Swiss accounts, costing the U.S. Treasury about $300 million annually. UBS bankers would visit the U.S. using tourist visas, attend yacht shows and art events to meet wealthy clients, and use coded language to discuss their financial services. When caught, the bank paid $780 million and, more shockingly, broke Swiss banking secrecy by turning over client information. The case effectively ended Switzerland's centuries-old banking secrecy laws and led to the Foreign Account Tax Compliance Act, FATCA, which forces foreign banks worldwide to report American account holders or face severe penalties. What's truly remarkable is how one bank's aggressive marketing of tax evasion services created a ripple effect that transformed international banking transparency forever. 6. When Standard Chartered processed $250 billion in Iranian transactions between 2001 and 2007, they weren't just breaking U.S. sanctions, they were writing a manual on how to do it. Bank employees were instructed to remove references to Iran from wire transfers in what they internally called Project Gazelle. When compliance officers raised concerns, one executive famously responded, "You fucking Americans! Who are you to tell us, the rest of the world, that we're not going to deal with Iranians?" The bank eventually paid $1.1 billion in fines across multiple settlements. The case transformed sanctions enforcement forever, establishing that non-U.S. banks could be severely punished for using the U.S. financial system while violating U.S. sanctions. It also revealed how easily international banks could exploit gaps between national regulatory systems, leading to much stronger coordination between global financial watchdogs who realized they'd been outplayed by clever bankers with creative interpretations of territorial jurisdiction. 7. The Deutsche Bank mirror trading scandal sounds like a rejected Tom Clancy novel, but it was all too real. Between 2010 and 2014, the bank's Moscow office helped wealthy Russians convert rubles to dollars and smuggle about $20 billion out of the country through simultaneous buy-sell orders of identical securities. The scheme was so brazen that Deutsche's compliance department flagged it multiple times, only to be ignored by management who apparently thought enormous profits justified enormous risks. When regulators finally caught on, the bank paid $630 million in fines. The scandal exposed how major international banks had become the laundromats of choice for oligarchs and kleptocrats. It also demonstrated how even after the 2008 financial crisis, banks were still willing to engage in highly suspicious activity as long as it was profitable. The case helped accelerate the global push for beneficial ownership registries and stricter anti-money laundering controls across the banking sector. Sometimes it takes a particularly egregious example of what's essentially financial espionage to force meaningful reform. 8. In the Bank of America. Countrywide mortgage crisis, America witnessed what happens when a relatively stable bank absorbs a ticking time bomb. After acquiring Countrywide in 2008, BofA inherited a mortgage portfolio so toxic it could have been classified as a Superfund site. Countrywide had been issuing loans to practically anyone with a pulse, including the infamous ninja loans: no income, no job, no assets. Bank of America ultimately paid over $50 billion in settlements, more than twice what they paid for Countrywide itself. The case became the poster child for disastrous acquisitions and the dangers of buying a competitor without properly checking what horrors lurk in their portfolio. It also dramatically changed how mortgage lending works in America, leading to the creation of the Consumer Financial Protection Bureau and regulations that now make it much harder to give six-figure loans to unemployed people with no money. Who would have thought such a rule would be necessary? 9. Goldman Sachs's Abacus CDO scandal reads like a financial horror story. In 2007, as the housing market teetered, Goldman created the Abacus 2007 AC1 synthetic CDO, allowing hedge fund manager John Paulson to essentially build a financial product designed to fail. Then, they sold this doomed investment to their own clients without mentioning that crucial detail. It was like selling someone a car after removing the brakes, while the mechanic who removed them bets on the upcoming crash. The SEC fined Goldman $550 million as a record at the time. This case exposed the conflicts of interest embedded in Wall Street's business model and became a central example in the push for the Volcker Rule and fiduciary duty requirements. Perhaps most importantly, it shattered the myth that sophisticated financial institutions like Goldman Sachs always acted in their clients' best interests. The scandal revealed that in the world of high finance, sometimes your banker is actually your bookmaker. 10 Citigroup's role in the subprime mortgage crisis wasn't just negligence, it was a masterclass in willful blindness. During the mid-2000s housing bubble, Citi originated and securitized billions in subprime mortgages, while internal reports warned many loans were likely to default. One executive famously remarked, "As long as the music is playing, you've got to get up and dance." When the music stopped, Citigroup needed a $45 billion government bailout to avoid collapse and later paid $7 billion in crisis-related settlements. The case exemplified how even the most sophisticated financial institutions abandoned risk management in pursuit of profit, requiring taxpayers to foot the bill for their recklessness. The fallout transformed banking regulation through Dodd-Frank and fundamentally changed how mortgage-backed securities are created and sold. In one of history's more expensive ironies, the bank that was once too big to fail learned that being big doesn't mean being smart or ethical. 11. The Credit Suisse. Tuna bond scandal is what happens when high finance meets absurdist theater. In 2013, Credit Suisse arranged $2 billion in loans to Mozambique, including $850 million for a state-owned tuna fishing project that largely existed on paper. The loans were hidden from the International Monetary Fund and most of Mozambique's own government. When discovered, the revelation plunged one of the world's poorest countries into economic crisis as international donors suspended aid. Credit Suisse eventually paid $475 million in settlements. The bankers involved received millions in kickbacks while Mozambican citizens paid the price through inflation and austerity measures. The case exposed the predatory lending practices sometimes employed by global banks in developing countries and led to stricter disclosure requirements for sovereign debt. It also demonstrated how easily corrupt officials and unscrupulous bankers could collaborate to steal from an entire nation, hidden behind the impenetrable jargon of structured finance. 12. The Royal Bank of Scotland's Global Restructuring Group scandal gives new meaning to the phrase, adding insult to injury. Between 2008 and 2013, RBS allegedly pushed thousands of viable small businesses into default, not to help them recover, but to seize their assets at bargain prices. Business owners who thought the bank was throwing them a lifeline were actually being led to the financial gallows. A 2016 parliamentary report found systematic mistreatment that destroyed livelihoods in companies that might otherwise have survived the financial crisis. What made this particularly outrageous was that RBS had received a $45 billion taxpayer bailout, essentially using public money to crush the very taxpayers who had saved them. The scandal transformed how UK banks treat businesses in distress, leading to new protections for small businesses and mandatory mediation processes. It also shattered the assumption that banks and their business clients naturally share aligned interests. 13. Danske Bank's Estonian money laundering scandal makes most bank heists look like petty theft. From 2007 to 2015, approximately $200 billion in suspicious transactions, mostly from Russia and former Soviet states, flowed through the bank's tiny Estonian branch. To put that in perspective, that's more than Estonia's entire GDP for that period, 10 times over. Whistleblowers were ignored, compliance was non-existent, and the branch's exceptional profitability raised surprisingly few questions. When finally exposed, the scandal triggered criminal investigations across multiple countries and forced Danske to exit the Baltic markets entirely. The case revealed catastrophic failures in cross-border banking supervision and led to a complete overhaul of European anti-money laundering regulations. It also demonstrated how a single branch in a small country could become the financial equivalent of a black hole, swallowing vast sums of questionable money that disappeared from regulatory view. Sometimes the most effective money laundering isn't done by criminals, it's done by the banks themselves. 14 Commonwealth Bank of Australia created the perfect money laundering machine, though that wasn't in the marketing brochure. Between 2012 and 2015, CBA introduced intelligent deposit machines that accepted anonymous cash deposits up to $20,000 per transaction without flagging suspicious activity. The bank failed to report over 53,000 transactions, creating a criminal's paradise. Drug dealers and money launderers quickly caught on, with some stuffing millions in cash into the machines. CBA paid a record of $700 million penalty in 2018. What makes this case particularly stunning is how technological innovation outpaced compliance. The bank was so excited about its fancy new ATMs that it apparently forgot about pesky details like anti-money laundering laws. The scandal forced all Australian banks to dramatically strengthen their transaction monitoring systems and led to a national reckoning about banking culture. In what must be one of history's more expensive demonstrations of the law of unintended consequences, CBA created a textbook case of how not to introduce new banking technology. 15 ING Bank's money laundering settlement reads like a what not to do guide for financial compliance. From 2010 to 2016, the Dutch banking giant processed hundreds of millions in suspicious transactions while apparently treating money laundering laws as optional suggestions. In one case, the bank accepted $150 million in cash deposits from a client without asking any questions, about $20 million of which was delivered in actual cash. ING paid $775 million Dutch prosecutors in 2018, one of Europe's largest money laundering penalties at that time. The case exposed how even banks in countries with strong regulatory reputations could catastrophically fail at basic due diligence when profits were at stake. It triggered a continent-wide reassessment of anti-money laundering enforcement and led to much more aggressive prosecution of financial institutions. The scandal also perfectly highlighted how banks often view compliance as a cost center rather than a core function, until the moment it becomes the most expensive department of all. 16. The Bank of Credit and Commerce International, BCCI, collapse in 1991 wasn't just a bank failure. It was the financial equivalent of finding out your respected neighborhood banker was actually running a global crime syndicate. BCCI maintained 2 sets of books, created phantom loans, hid losses, and established a bank within a bank to handle the more questionable activities like money laundering for dictators, drug cartels, and terrorists. When regulators finally shut it down, depositors lost an estimated $10 billion. The scandal was so comprehensive that investigators coined the term criminal enterprise to describe BCCI's business model. The collapse led to major banking regulatory reforms worldwide, including much stricter rules for licensing international banks and better coordination between national regulators. It also permanently changed how central banks approach systemic risk, establishing that a bank's reputation means nothing if nobody is actually checking what's happening behind the mahogany counters. 17. The Société Générale, Jérôme Kerviel. Trading loss of 2008 revealed just how meaningless risk controls become when nobody's enforcing them. Trader Jérôme Kerviel created $50 billion in unauthorized positions, more than the bank's entire market value, resulting in losses of $4.9 billion when discovered. What's truly remarkable is that Kerviel didn't particularly try to hide his activities. The bank just failed to investigate dozens of red flags because he was making money. When SocGen finally caught on, they unwound his positions during a market downturn, maximizing their losses. Kerviel was sentenced to prison and initially ordered to repay the full $4.9 billion, a sum he would need about 111,000 years to repay on his post-prison salary. The case transformed trading floor supervision worldwide and contributed to the European Union's decision to cap banker bonuses. It also revealed the fundamental hypocrisy in banking culture. Excessive risk is celebrated when profitable, but becomes unauthorized fraud the moment it loses money. 18. The HBOS corporate banking scandal was banking corruption so brazen it could have been a Netflix crime series. Between 2003 and 2007, corrupt HBOS bankers deliberately destroyed viable businesses by forcing them to hire specific turnaround consultants, who then extracted millions in fees while asset stripping the companies. Businesses that had approached their bank for routine financing found themselves trapped in an elaborate extortion scheme run by the very people they'd trusted with their financial futures. The Thames Valley police investigation resulted in 6 people being jailed for a combined 47 years, a rare example of bankers actually facing prison time. This hybrid of comedy and commentary would be almost entertaining if it hadn't devastated hundreds of business owners and their employees. The scandal led to fundamental reforms in how UK banks handle business distress situations and new protections against conflicts of interest. It also stands as a sobering reminder that sometimes the biggest threat to your business isn't the market or your competitors, it's your own banker. 19 BNP Paribas took sanctions violations to an entirely new level of audacity. From 2004 to 2012, the French bank processed $9 billion in transactions for Sudan, Iran, and Cuba in violation of U.S. sanctions, often using elaborate schemes to hide the countries involved. Internal emails showed employees were explicitly instructed to remove references to sanctioned countries, with one compliance officer writing, "The transaction will get blocked in the U.S. and it will be a disaster for all of us." When caught, BNP pleaded guilty and paid $8.9 billion in penalties. The case dramatically changed how foreign banks approach U.S. sanctions, establishing that using the U.S. financial system means following U.S. rules, regardless of whether your home country agrees with those sanctions. It also created a new standard for penalties, moving from millions to billions, effectively putting every bank in the world on notice that the cost of deliberate sanctions evasion had increased by several orders of magnitude. 20 Morgan Stanley's Perkins Smith discrimination case exposed the reality beneath Wall Street's polished facade. Throughout the 1990s, female employees faced systematic gender discrimination in pay, promotions, and even basic workplace respect. Women were regularly excluded from client golf outings and taken to strip clubs for team building. The firm paid $54 million in settlements in 2004 and agreed to implement anti-discrimination measures after hundreds of women joined a class action lawsuit. What made this case particularly significant was how it forced Wall Street to confront its frat house culture at a time when many financial institutions still operated like exclusive men's clubs. The settlement became a template for subsequent gender discrimination cases across the financial industry and accelerated the adoption of more comprehensive diversity policies. It also empowered more women to speak out about workplace discrimination, helping to gradually shift banking culture, though the industry's diversity statistics suggest the journey remains far from complete. 21 ABN AMRO's sanctions and money laundering case reads like a textbook on regulatory negligence. Between 2014 and 2017, the Dutch bank processed billions in suspicious transactions, despite repeated warnings from regulators. The bank maintained accounts for companies trading with sanctioned countries and failed to verify the source of large cash deposits. One client deposited $550,000 in cash over multiple transactions without the bank asking any questions. ABN AMRO eventually paid $480 million Dutch prosecutors in 2021. What makes this case remarkable is that it happened after the global crackdown on money laundering, as if ABN AMRO had somehow missed the memo that every other bank had received. The scandal led to stricter personal liability for Dutch banking executives and accelerated the implementation of advanced transaction monitoring technologies. It also demonstrated how even banks that had been previously penalized could fall back into old habits without a fundamental change in compliance culture. 22. The Northern Rock crisis of 2007 transformed a mid-sized British mortgage lender into a symbol of financial fragility. Heavily dependent on short-term wholesale funding rather than customer deposits, Northern Rock became the first British bank in 150 years to experience a bank run when the interbank lending market froze during the early stages of the financial crisis. The iconic images of customers queuing around blocks to withdraw their savings shattered confidence in the entire banking system. The UK government ultimately nationalised the bank to prevent systemic collapse. The case fundamentally changed British banking regulation, leading to new liquidity requirements and the creation of a formal bank resolution framework. It also permanently altered how central banks approach their lender of last resort function, recognizing that in the age of 24-hour news and social media, bank runs can happen at previously impossible speeds. Sometimes the most important financial lessons come from watching a supposedly stable institution implode in real time on national television. 23. The Swiss Bank Program. Tax evasion settlements revealed the largest tax haven operation in banking history. Between 2009 and 2016, over 100 Swiss banks paid approximately $1.36 billion to the U.S. Department of Justice for helping American clients hide assets from the IRS. These weren't just passive accounts. Banks actively helped clients create shell companies and convert assets into gold bars stored in private vaults. Some bankers even smuggled cash into the U.S. in toothpaste tubes or carried diamonds in their underwear to avoid detection. The program's scope was staggering, effectively putting an entire country's banking secrecy model on trial. It permanently ended Switzerland's centuries-old banking secrecy laws and created a new international standard for financial transparency. The settlements also triggered a global hunt for hidden wealth, resulting in tax amnesties in dozens of countries and the recovery of billions in previously evaded taxes. What had been a genteel, quietly accepted practice suddenly became a criminal enterprise, forcing a complete reinvention of Swiss banking's business model. 24. Rabobank's interest rate manipulation scandal exposed just how casually bankers rigged the global financial system. From 2005 to 2011, Rabobank traders manipulated LIBOR and Euribor, benchmark rates affecting trillions in financial contracts, to benefit their trading positions. Traders would literally send messages like, "Don't forget about me. Small adjustments in LIBOR fixings can make nice money." The Dutch bank paid over $1 billion in fines to regulators across 4 countries. What makes this case particularly striking is the complete absence of moral awareness. Traders manipulated global interest rates affecting millions of mortgages and loans with the same casualness as ordering lunch. The scandal contributed to the complete overhaul of how benchmark rates are set and created new criminal penalties specifically for rate manipulation. It also revealed how a system built entirely on trust and self-reporting was vulnerable to abuse, forcing regulators worldwide to reconsider fundamental assumptions about market integrity and banker ethics. 25. Lloyds Banking Group's HBOS acquisition has become the textbook definition of buyer's remorse. In 2008, Lloyds TSB hastily acquired the failing HBOS without adequate due diligence, discovering too late that they'd purchased what was essentially a financial black hole. The combined entity required a $20 billion government bailout, and parliamentary investigations revealed Lloyds executives had misled shareholders about HBOS's true condition. What makes this case fascinating is how the financial crisis created a perfect storm where traditional competitive caution was abandoned in favor of empire building, with catastrophic results. The scandal led to new regulations governing bank mergers, mandatory stress tests for major acquisitions, and much stricter disclosure requirements for shareholder votes. It also created a template for how not to handle a banking crisis, demonstrating that forcing hasty mergers between troubled institutions often creates bigger problems rather than solving existing ones. Sometimes the cure turns out to be worse than the disease, especially when administered in a panic. 26. Fifth Third Bank's mortgage fraud settlement exposed how even regional banks jumped on the subprime mortgage bandwagon. Between 2005 and 2007, the bank originated and sold mortgages with blatantly false information about borrowers' incomes and property values. In some cases, the bank approved loans where borrowers claimed to earn more than 10 times their actual income. Fifth Third paid $18 million to settle Justice Department allegations in 2017. A decade after the fraudulent loans were made. What makes this case particularly notable is that it wasn't limited to the giant Wall Street banks. Mortgage fraud had become so normalized that even traditionally conservative regional banks were participating. The settlement contributed to the complete overhaul of mortgage underwriting standards and the creation of the ability to repay rule. It also demonstrated the lasting consequences of financial misconduct. Fifth Third was still paying for violations committed a decade earlier, showing that the statute of limitations for financial crimes may be longer than bankers might hope. This analytical reflection with closing wit reveals how quickly problematic practices can spread throughout an industry when everyone's chasing the same profits. 27. Santander's auto loan discrimination case revealed the hidden prejudices built into financial algorithms. From 2010 to 2013, Santander Consumer USA's lending practices charged higher interest rates to minority borrowers than white borrowers with similar credit profiles. The bank paid $22 million to settle allegations with the Justice Department in 2017. What makes this case particularly significant is that the discrimination wasn't necessarily intentional. It was embedded in their pricing models and dealer compensation systems. The settlement transformed how lenders approach fair lending compliance, leading to much greater scrutiny of algorithmic decision-making and statistical disparities in pricing. It also highlighted the emerging challenge of digital discrimination, where seemingly neutral financial algorithms perpetuate or amplify existing societal biases. The case demonstrated that in the age of big data and automated lending, civil rights enforcement needs to focus not just on individual bias, but on systemic outcomes, because discrimination doesn't require conscious prejudice to cause real harm. 28. The ANZ cartel case interest rate manipulation scandal exposed Australia's banking elite engaging in precisely the kind of collusion they'd always denied. In 2012, ANZ and other major Australian banks allegedly conspired to manipulate the bank bill swap rate, Australia's equivalent of LIBOR, through coordinated trading and information sharing. The Australian Competition and Consumer Commission filed criminal cartel charges in a case that shocked the nation's financial establishment. What makes this case noteworthy is how it evolved from civil to criminal charges, reflecting regulators' growing willingness to pursue individual criminal liability for financial misconduct. The proceedings transformed Australian financial regulation, leading to automated systems for setting benchmark rates and removing human judgment from the process. It also shattered the public's trust in Australian banking, revealing that the big four banks that dominate the market weren't fierce competitors, but rather collaborators when it suited their trading desks. The scandal ultimately contributed to a royal commission into banking misconduct that revealed even deeper problems throughout Australia's financial system. 29. Swedbank's Baltic money laundering scandal proved that lightning can indeed strike twice in the same region. From 2007 to 2019, approximately $5.8 billion in suspicious transactions flowed through Swedbank's Baltic operations, many connected to the same suspicious clients involved in the Danske Bank scandal. The bank's CEO initially denied any problems before being forced to resign as evidence mounted. Swedish and Estonian authorities launched criminal investigations that continue to this day. What's truly remarkable about this case is that it happened after the Danske Bank scandal had already exposed the region's vulnerability to money laundering. Swedbank apparently watched its competitor's epic scandal unfold and somehow concluded this is fine, rather than immediately reviewing its own Baltic operations. The case accelerated the implementation of a unified European anti-money laundering authority and forced Nordic banks to completely reconsider their risk appetites. It also demonstrated how quickly financial misconduct can transform from a competitor's problem into an existential threat to your own institution. 30. Toronto Dominion Bank's anti-money laundering failures demonstrated that even Canada's conservative banking system wasn't immune to compliance lapses. Between 2018 and 2021, TD Bank failed to properly monitor and report suspicious transactions at several U.S. branches, allowing millions in suspicious cash to move through accounts with minimal scrutiny. The bank paid $20 million FinCEN and faced ongoing regulatory scrutiny. What makes this case notable is that it occurred after most major banks had already paid massive penalties for similar violations, and had supposedly strengthened their compliance systems. The violations suggested that despite public commitments to fighting financial crime, many banks still treated compliance as a cost center rather than a core responsibility. The case contributed to the complete overhaul of how regulators assess anti-money laundering programs, moving from technical compliance to effectiveness assessments. It also highlighted how even banks with strong reputations for risk management could develop blind spots when expanding into new markets. 31. Mizuho Financial Group's Yakuza lending scandal exposed how Japan's corporate culture can enable problematic banking practices. From 2010 to 2013, Mizuho Bank maintained lending relationships with companies connected to Yakuza, organized crime groups, despite internal reports identifying these connections. When the scandal broke, the bank's management engaged in a classic circle of blame, with executives pointing fingers at each other rather than accepting responsibility. Japanese regulators imposed business improvement orders and multiple executives resigned. What makes this case particularly fascinating is how it exposed the tension between Japan's tradition of consensus-driven decision-making and the need for clear accountability in modern banking. The scandal led to fundamental reforms in Japanese banking regulation, including personal liability for executives who failed to address compliance issues. It also forced Japanese banks to strengthen their due diligence processes and create clearer lines of responsibility. Sometimes the most damaging financial scandals aren't about what bankers do, they're about what they fail to do when presented with clear evidence of problems. 32. Bank Hapoalem's Swiss tax evasion case read like a spy novel if spies specialized in tax strategies. Between 2002 and 2014, the Israeli bank's Swiss subsidiary helped American clients evade taxes through undeclared accounts, code names, and numbered accounts. Bankers would travel to the U.S. to meet clients, holding secret meetings in hotels and restaurants to discuss how to hide assets from the IRS. The bank paid $874 million to U.S. authorities in 2020, one of the largest penalties imposed on a non-Swiss bank for tax evasion. What makes this case significant is how it extended the U.S. tax enforcement campaign beyond Swiss banks to the global financial system. The settlement served as a warning that no foreign bank, regardless of size or home country, was beyond the reach of U.S. tax authorities. It also demonstrated how quickly banking secrecy went from a legitimate business model to a criminal enterprise, forcing financial institutions worldwide to fundamentally reconsider their approach to client confidentiality. Banking practices that had been standard for decades became evidence of criminal conspiracy almost overnight. 33. Westpac's Austrac money laundering violations weren't just compliance failures, they were moral catastrophes. From 2013 to 2019, Australia's second-largest bank failed to report over 23 million international fund transfers and adequately monitor transactions that funded child exploitation in the Philippines and Southeast Asia. Some customers made frequent small transfers to people later arrested for operating child exploitation rings, following transaction patterns that should have triggered immediate investigation. Westpac paid a record a $1.3 billion penalty in 2020. What makes this case particularly damning is how the bank's failures enabled some of the most heinous crimes imaginable. The scandal permanently changed how banks approach transaction monitoring, moving beyond technical compliance to focus on the human impact of financial crimes. It also demonstrated that in the court of public opinion, not all compliance failures are equal. Those that enable harm to children carry particular reputational damage that no PR campaign can easily repair. This analytical reflection with closing wit reveals how quickly a bank can transform from trusted institution to public pariah when its systems fail to detect transactions that the public finds morally repugnant. So that wraps up our journey through the world's biggest banking scandals. From Wells Fargo's fake accounts to Westpac's money laundering violations, these cases expose how the guardians of our money became the greatest threats to financial integrity. But now it's your turn. What do you think? Are these scandals merely isolated incidents of greed or evidence of a fundamentally broken system? Perhaps the LIBOR manipulation or HSBC's cartel money laundering changed your perspective. Did we miss any banking catastrophes you think deserved a spot on our list? Share your thoughts below. The most insightful comments get pinned. If you valued this expose of corporate corruption, prove it. Hit subscribe and join us next week for our deep dive into tax haven paradise papers.